Hello, welcome to another podcast episode from BG Private. My name is Triana Butler. It's great to have you here. Now, do you want to invest in shares but you don't know where to start? That is literally describing me. You've come to the right place, as apparently have I. We've got with us today BG Private financial advisor Adrian D'Mello. He's going to give us a 101 on everything you'll need to know: how to buy shares, how much money you'll need to get started, how to choose which shares to buy, when to buy in, all of the good stuff. Adrian, hello, welcome.
Hello, Triana.
First time on the podcast, First time in the studio. Good to have you here.
Brilliant. Thank you.
Now, we are recording this in May 2025. A wider look at the world. There is Donald Trump has some what we're calling tariff wars on various countries, and that's causing some real volatility in the stock market. As an experienced financial advisor with BG Private, are you tossing and turning at night worrying about this?
We certainly couldn't have timed this podcast any better. Generally during periods of volatility, when the price of shares are moving up and down and unpredictable, fluctuating sharply, I'll have a few clients call me up, eager to discuss potential changes to their investments. And, it's natural to panic and want to sell to avoid a further share price drop. Markets could always fall a bit lower. But on the whole, my clients have gone through something similar in the past and remained long-term investors. Just to reiterate out there, part of my job as a financial advisor is educating our clients, which involves teaching them to be patient investors. And that means staying the course even during periods of volatility. At the end of the day, we invest in shares to earn a high return over the long term. And the short-term volatility is just a price of admission. All right? It's a common saying in our industry. More importantly, if you cash out when there's a drop in the market, who's to say that you will end up buying back in and participate in the recovery, right? It's generally after the crash, the markets rebound fairly quickly. And so often than not, I see investors still holding cash, wondering, is this a good time? Or maybe it's going to fall again. So trying to time the market generally doesn't work. Now, I've gone about the really long way in telling you that Trump can try, but he's not going to give me or my clients sleepless nights. Because we actually look at this as an opportunity. And fundamentally, we're all long-term investors with a smile on our dial.
All right, well, that seems like a good place to start. Now, I think I know what the answer is going to be here, Adrian, but do you recommend investing in shares? Good idea?
Absolutely. I've not heard of too many investments where you can start with as little as $500. It's easy to set up a brokerage account and the transaction fees are low. Okay, so that basically suits anyone and everyone. Comparatively to buy an investment property, you need a sizable deposit. Transaction costs like stamp duty and agent fees are a lot higher to start. But that's not all. Shares in Australian companies pay a high level of income in the form of dividends. Now, dividends come from company profits and are generally paid regularly to shareholders, most likely twice a year, some a bit more, some a bit less. The top 200 shares in Australia would pay an average dividend of about 5%. Comparatively, investment properties as best would provide rental income of 2 to 3%. Cash in the bank account would be maybe 4 or 5%. With the rate cut expected, you'll get a bit less. Now, in addition with shares, you might also be entitled to franking credits. Now, this is a refund of the tax that companies already pay on your behalf. So you're not being double taxed, right? And when you look at it, you can't go past shares in terms of the return they offer. All right. So when you look at it, you can't really go past shares in terms of the return they have on offer. Of course, it doesn't have to be an either or. For example, while you're looking to save up that elusive deposit to buy a property, most start by investing in shares and will help you reach that goal a lot sooner.
Now, you touched on earlier the volatility that is in the share market currently. There is a lot of going up, there's a lot of going down. It looks like chaos out there. I imagine that is the kind of time where a lot of people are sitting back and going, oh, I'm not sure about this. This all looks very scary. So when would you recommend someone get started?
You're absolutely right. This happens all the time. And I guess that's the benefit of coming to a financial advisor or an investment professional. Let's say the market suddenly falls 10 to 15% like it did in the last few weeks. It could possibly fall further. So you may think you're better off waiting to buy at an even lower price, getting even better bargains.
Buy the dip, right?
Exactly. But what if you wait and it quickly rebounds? You're most likely going to miss out, right? So it's tricky business trying to time the market. And as an advisor, I forever encourage my clients to avoid trying to time the market. The answer is just to get started. And at the same time, the smart thing to do is put some money aside in case the market were to fall further, so you can buy in cheaper, right? So you're not really losing that opportunity. If not, you're already invested and will benefit from the rebound. Let's look at this in another way. I used to work in retail in another life. At the time, we would sell sports shoes, and Asics Keanu's used to be the most expensive sneaker, but boy, did that feel amazing when you slipped on a pair. They would retail at $240, a lot more now.
Jeez, were they that much even then? Yeah, right.
And there was no way I could buy a pair. Too dear for me. But plenty of customers did, and they were happy to do so. On the other hand, I would wait to buy them when the store had 30% off. And just before a new version came off, the older versions would be at a bargain as well. And then I'd pick up another pair, right?
That's how I do it.
Back then, I did a lot of running too. Not anymore. Shares are similar, exactly the same. You might think they're expensive, but they still offer value to other investors. But equally, it's great if you can buy them on sale or even when there are further markdowns. If you only have a small amount to invest, it's wise to be more careful with your money. Start investing, but remember to keep some powder dry to capitalize on the market dips. Not to confuse our listeners, but I'm going to share another important concept, which is kind of a financial metaphor. And what we say is, don't try to catch a falling knife. Just imagine the image that should tell it all. It suggests we should be cautious against buying a stock that is experiencing a rapid and sharp decline in price, because there's no guarantee that that price will stop falling, which can lead to significant losses if you are in a great hurry. So what we should do is take a bit of time and research that bargain. A bargain is not always a bargain. Maybe take some time, wait for the price to stabilize, and enter when there are signs of a recovery. Okay? And that's especially important when you're starting with a small amount of money. You want to protect your capital. Okay? Over time and over an investment journey, the market teaches you a number of lessons, and with experience, you start to build your own style. It's best I take a minute to summarize what we've just discussed, right? A, don't try to time the market, just start investing. If prices are falling, take advantage and buy in again at lower prices. Ensure you keep some money in reserve so you can always capitalize on further drops.
Okay, so for someone who is listening to this and they've just heard all of your advice and they're like, okay, Adrian, I hear you. I'm going to start out. What's the first step? What do they do?
Like with anything, if you want to buy anything, there's a marketplace. And once again, for shares, we have the ASX, right? At the share market, you need to have a licensed broker who acts on your behalf. It's akin to using a real estate agent, right? Back in the old days, you would call your broker to discuss your trades. But nowadays, we have online brokers where all your buying and selling is done with a few clicks. The broker on the phone is still there, but that's more reserved for the investor with deep pockets because the brokerage is rather high.
Right, and time is money. So I can't just rock up and just be like, oh, I'd like to buy some of this. I need to go through someone else to do that.
Absolutely, yeah. Now, to find a broker, all you need to do is Google online share trading broker, and you'll find many options. Some of them actually offer a demo account, so you can take it for a spin. Literally within a few hours, you could set up an account link your bank account because you need the cash, right?
Of course.
And be ready to make your first trade.
Okay, now when you are Googling online share trading broker, what do you need to consider? What are the kind of things that someone should be looking for if they're going to do this?
What's the most important with everything? It's the cost or the fees. Generally, a common term with share trading is called brokerage. And what we want to see is to have the lowest brokerage because that means there's more money going to be left in your pocket.
What's like a regular amount of is it like a percentage of it? Is it a flat fee? How do they do it?
It comes in a few shapes and forms. There'll be a minimum fixed fee, like $10. And then obviously you could be investing millions. So $10 doesn't seem fair, I guess.
Yeah.
So there's a percentage. But they will generally have a place to top it up. When you start investing in large amounts, most likely you would be speaking to a broker over the phone and they'll be giving you a good rate. Yes. Right,
okay. I hear you.
Okay. Now, I myself do share trading and I pay $10 a trade each time I trade a share. My friends tell me I'm a bit crazy because I could be paying $3 a trade. Now, with my experience, I've seen that in the marketplace, and out here what I would do is provide you with some caution, right? Now, when you're paying very low brokerage, the broker might be able to give you those low costs because they're putting their trades in bulk. So they might be buying the shares at a time in the market when the price may not be what you're willing to pay for. So they could be paying a lot more than you want to pay, right? Because they're buying in bulk. They're buying for a few people at the same time to save their cost and provide you a lower fee. Additionally, a cheaper broker may hold shares in trust for you, which actually means that they're holding the shares in their name on your behalf. And since you don't directly own the shares, if anything were to go wrong with the brokering company, you can imagine what's going to happen. You're at risk that you may lose access to your shares. In other words, cheaper is not always better, and you should try to ascertain how the broker operates and how the shares will be held. You can also have a qualified financial advisor like myself take you through the process to ensure that you start off safely. While the main purpose of the broker is to act as an agent and trade on your behalf, there are some other features to consider. Okay, so we talked about going online and opening a brokering account. What do you get on those accounts? Some brokers will have online as well as an app, so you can see your holdings and the value in real time.
I think I've seen some of these apps and they're like, oh, you can see what it's doing and there's charts and graphs and all sorts of information. Is that something that you would recommend? Is that good or bad?
Yeah, I mean, as an advisor, you generally tell the client, don't be looking at your portfolio every day.
Right, okay.
But, nothing's to stop you from looking at that balance going up, especially when you see, I guess you're watching the news and they go, oh, the market's gone up 3% today. You go, oh, what did my portfolio do?
Right.
It's always a great opportunity to look at the app. Some people are frequent traders. So at a whim, they'd look to trade a share. And if you're away from a computer, how better than to do it on an app? So that provides that offering as well. Sometimes, though, these apps, because it's free, they'll have a price delay. So, they're showing you the price what was 15 minutes ago generally. If you pay a subscription fee, it turns on the real-time prices. So if you are an active trader, it makes sense to pay that subscription. Generally, if you're a frequent trader, that subscription fee is waived because the broker is making that up in brokerage. But, you pay for what you get. I would say that you don't need to worry too much about all of these things. It's pretty much easy to get started. Have a start, have a try, and then if things are not working out, you hear of someone better or a brokerage company that's has better features, it's just easy to move across to them and take your shares with you.
Right. Okay. So how much money does someone need if they want to start investing? Because you said it's quite a low entry level?
Absolutely. The ASX, that's the Australian Stock Exchange, they mandate a minimum of $500 for each buy, right? So effectively to commence trading, all you need is 500, but don't forget the brokerage. It's 500 plus brokerage.
Okay, so that makes it pretty easy to start then, 500.
That's true. And so many people start their journey because it's that easy to start with a small amount of funds. But in my opinion, the notion of starting with 500 makes it really easy, but at the same time, it's probably one of the biggest traps in my opinion. And why, you might ask? You've heard of the term diversification, right? Mm-hmm. Which is effectively avoiding putting all your eggs in the one basket. So buying shares in only one company or having all your investments in the one asset class, like property, is probably not the best idea. Okay. If you only have 500 to invest, then naturally you'll be only investing in that one company. So you won't be diversified.
Right. Okay. So it is quite literally putting all of your eggs in one basket then. So how many companies would you then need to have if we're looking for something to be diversified? Like what's the ideal number? Yeah, I mean, there's different points of view on this. I would generally say 10 to 20 different companies across a variety of sectors. So you're not just all buying in, say, I don't know, entertainment or all in property. You want to mix it up a little bit. Absolutely. Or if lithium is the latest kid on the block, you don't want to buy just lithium shares. So a bit of retail, healthcare, mining, telecommunications. So 10 to 20 shares across all those different sectors. It's important to diversify again across sectors because some sectors are stable, and regardless of what's happening in the market, what Trump is saying, no matter what, people will continue to shop at places like Coles or use a phone. Right? So these are stable sectors. While other sectors' performance is subject to things like how the economy is performing. When things aren't going too well, fewer people are going to go borrowing from a bank to build a new home, right? So bank profits are not going to be going up, possibly. During tough economic times, banks, building companies are unlikely going to go up in value, and we describe these sectors as being cyclical in nature. By buying shares in company in different sectors, at any point of time, you're likely to hold companies that are doing well while others struggle. So there's probably maybe 6 or 7 that are doing well and maybe 3 of them are not doing so well. But on the whole, generally, you're kind of ahead. Is that the idea? Perfectly said, yeah. Now, over the short term, it's exactly as you described. But over the long term, all these companies would have gone through a market cycle. And that's allowed them to get back on track, and over the cycle, at the end of it, you'll find that all of them should have appreciated from where you bought them at. So now let's look at things in another interesting manner. When the economy is booming, cyclical companies perform really well, and they're likely going to be trading at higher prices. So one way to make money is to be contrarian. This means you are looking to buy cyclical companies when their prices are low, when things are not going well, right? So right now, when people are afraid of a recession, they're probably not going to buy building companies or companies in that sector. So now could be a great time to get some of them at a bargain. It's important to note that it's almost impossible to get all your purchases right. There will be some companies that you make a huge profit, while others you make a loss. At the end of the day, as long as you have more winners than losers, you're going to be ahead with your portfolio, right? And finally, while diversification is important, investing in any more than 25 companies generally removes the benefit. Why is this? Because when you start getting over 25 companies, you're going to find you have overlap. You probably own a few companies in the banking sector, or you'll own 2 supermarkets. And in Australia, the companies on offer, the sectors available are fairly limited. So that's where going over 25 companies is not ideal. Once again, if you're going to go with 25 companies, you've got to have a whole lot of dosh behind you as well. Okay, so I know you mentioned earlier that you're going to need probably only $500 to get your first shares purchased. But from the sound of it, if we're investing in multiple companies, you're going to need a little bit more than $500. Is that right?
Yeah, that's for sure. So let's look at a more realistic amount to start with. If you decide you're going to start buying shares in 10 companies because you like to diversify at 500 minimum, you'll need about $5,000 to start. Remember, I also said keeping some cash in reserves in case the share price were to fall. So you'd probably need about another $5,000 to buy if the market were to fall. So all up, you'd probably need about $10,000.
Okay, now what about on an ongoing basis? Because presumably it's not just the $10,000 right up front. Like, let's say you want to budget some money each time you get paid that you're like, okay, that's going to be the money that I invest with.
Yeah, and that's totally, that happens to everyone. Each trade is $500. So let's say you budget to invest $1,000 each pay, then you can buy shares in 2 companies with that, right? If you can only budget $250 per pay, then you probably need to wait after 2 pays, save up a bit, and then you can go into the market with that minimum $500.
Okay, so we've got the broker account, we've saved up, we're ready to go. You mentioned before there's different styles of doing it. There's different kind of approaches. What are the general ways that you could go about doing this?
Sure. So distinctively, you can always place people who buy and sell shares into 2 buckets. One's the trader and the other's the investor. So what does a trader do? They buy and sell shares based on market trends. Usually the people who have 5 or 6 screens set up and there's charts and different colors. Now, they might buy and sell the share within the same day, or they might wait a couple of weeks, but not for too much longer. With this approach, you generally are doing a whole number of trades, so you're a frequent trader. It's not unheard to hear that most of these trades, up to even 60 or 80% of them, are losing trades. But what the aim here is, on the trades that you do make profit, the profit is a whole lot big to cover those losses, right? While trading like this has been profitable for heaps of people, I believe it's risky. It requires a lot of discipline, and most people don't have that. So imagine you've had 10 trades losing. You're going to try and wanting to do something different, reinvent the wheel almost. Also, because you're frequently trading, you need a decent amount of savings. And at the end of the day, you really need to know what you're doing. When you're starting off, I'd be really cautious to start this way. I might suggest, if you're so inclined to do so, possibly paper trade. What that means is don't worry about the money, keep a journal, and buy and sell the shares on a piece of paper. And if you've been...
Do you mean like you're pretending to buy them? Or
Exactly.
So you're like almost playing it like play pretend?
Absolutely.
Got it.
So make sure you're good at doing this before you put real money at risk, okay? Because I don't know about you, but it generally takes me a while before I start saving. And in line with this, there are a lot of advertisements out there with companies promising to reveal their secrets to trading, so you can swap your day job for a few hours of trading and achieve that all elusive financial freedom. But the reality is, a very few people are focused enough to follow the rules, and even then, following the rules doesn't guarantee that promised outcome. Market conditions might mean you're starting at the worst time possible, and you fail, unfortunately. On the other hand, an investor is most likely looking to hold that company for a long period of time, a very long period sometimes. It's based on a very simple premise. As companies grow their earnings over time, they become more valuable, and their share price follows. And at some stage, they will start paying out some of their profits to shareholders. We talked about dividends before. As a long-term investor, you benefit from both the share price increase over time, as well as getting paid dividends while you're holding the shares.
So how does this work? Like from start to finish, what's the process there?
Oh, you buy some shares in a company that you think will increase in revenue and profits over time. Then you sell it at a profit when the share price increases. Generally, you will sell your shares once you reach your intended goal. For example, your portfolio increases to the value, so you can buy a home deposit. Depending on the size of your investment, along the way, you might also receive dividend payments that you can use for a holiday or even a car, depending how big your portfolio is. Alternatively, you can have those dividends reinvested and reach your financial goals sooner because you're reinvesting your income. Some investors even hold on to their shares for a very, very long time so that the share portfolio can support them in their retirement.
Right. Okay. So how do you pick which company is going to increase their share value? Like, how do you know?
Okay. This part is going to sound easier than it actually is. As an investor, you're looking to buy into a company that grows its profits over the long term, year on year. As this is the catalyst that will finally lead the share price to increase. And that means your portfolio is going to make money. So what are the signs for this? For example, take my favorite go-to place for lunch, Guzman and Gomez.
Yes! Up top. Love GYG. Let's go.
We're giving them a free plug out here. Now, these guys would grow their earnings by continuing to open restaurants throughout Australia. When they first started, there weren't that many shops, but they've continued to grow. So really, they're continuing to bring in that revenue. A well-known biotech company in most portfolios is CSL. And that over the years has grown from a share price of $2.50 to over $250 today, right? All it's done is over time provide more products and entered more markets. Now, all of this activity, and can be in different shapes, leads to high revenue, more profit, and more shareholders will buy, raising the price up. Selecting companies that will grow is the hard part. But a well-renowned fund manager, Peter Lynch, suggested all you need is a common sense approach. Take Guzman and Gomez. You can see new restaurants opening all over. If you walk in, there's always a line signaling high demand for their food, right? You might observe a mix of people who go there. School kids, adults. That's why you're waiting in line, because everyone's, heading out there.
I'm there. I'm in the line. I know what you're talking about.
Now, you also notice it's open for breakfast. Now, what's a burrito place going to offer you at breakfast?
A breakfast burrito.
Exactly, right? So it's got every meal covered almost. And all of this is going to signal that there's demand for their products and means that company is more likely going to be successful, right? Now, everyday investors can observe retail shops more easily, but there are some sorts of companies that they don't have the same kind of visibility. How are you going to go about finding them? And this is where you go about conducting research, okay? You don't have to do a thesis on this. So where are you going to do your research? There are a number of podcasts where investment professionals are interviewed, and obviously they want you to know how well they are at identifying stocks, because that's the name of the game. So they'll maybe release a few secrets on an interview. You find investment newsletters and information services provided by various research places. One of the common ones are LinkedIn Stock Doctor. We talked about the broker having subscription services. Part of their subscription might be to research. So you pay the subscription and the research. And what do you find in the research? A more detailed analysis of the company, the share price they believe it should be, the current share price, etc. But sometimes it's also luck. You might overhear a conversation, then research that company. You might like it and you might buy it. Like everything, the more work you put in it, I find you tend to get luckier.
That old catchphrase. Now, let's say you've picked out a company, you're like, yeah, this has got really good growth prospects. How do you know when's the good time to buy? Like, how do you know that it's the dip?
That's the next important question. And that's what keeps people away. Remember we talked about the ASIC sneakers? Why are some people happy to pay full price? Because they know how good the shoes are, right? Nothing else is going to compare, and they know they're going to get good value out of it. Similarly, in any case, companies that have good prospects will most likely have already been identified by many people, and they're not going to be cheap. You buy them nevertheless, because over time, their share price should continue to rise. When CSL was $100, it was expensive to some, but we still bought. And where are we today? At $250. Now, alternatively, you might wait for the sneakers to go on sale. You might wait for a market correction or a dip and pick up good companies occasionally at bargains. So you could set up a watch list and then watch the price. And when you feel comfortable, you can enter the market. There's always something to buy.
Right. So what if you don't have time or you couldn't be bothered to do all this research on companies and share prices? It does seem like a lot to have to know, almost the entire universe of how everything works and how every company works to be able to make that decision.
True. If I were being honest, that's probably when you figure out you don't possess the patience and the skill required to do this all yourself. And that's when you turn to an investment professional. There are people probably that have a number of degrees and have spent a lifetime of learning, and they've stuck with it, right? They've learned a lot from life lessons. There are plenty of life lessons for them to have experienced. They spend their time researching, setting up these complex financial models, looking at financial statements, speaking to company leaders about their future plans, speaking to competitors, speaking to people in the supply chain. They're speaking to their customers, working out the demand for their goods. So that all takes time. With all this effort and expertise, they're in a better place to understand which companies are likely to grow in value. These investment professionals manage your money on your behalf by pooling the savings of many investors into a managed fund. The number of units you own in this pool depends on the size of your investment, right? If you put a lot more money, you'll get a lot more units. The pool of funds is then used to buy shares. If the shares increase in the value, so will the pool, and so will the value of your units. And conversely, if the value of the shares fall, so will the unit price, and so will your investment. Investment professionals do charge a fee for managing this pool of funds.
Well, it makes sense. They're putting all the work in there, so you don't have to think about it. So I guess that's the price of admission. Now, let's say you feel a little more comfortable going down this route. How do you go about selecting which managed fund to join? Like, what are the things you should be looking for?
Similar to shares, but a lot easier. You would need to research various available fund managers available out there. For example, there are podcasts I talked about before where investment professionals are interviewed. And of course, all of them have a website, and there's plenty more information about them on the website. There are rating houses that list and rank different fund managers based on their performance. You could have a friend that's been investing, and they could recommend you a fund manager. But if you are going to if you're going to consider a fund manager, here are a few things that you would use to select one. Right on top of the list is their fees. The less they charge, the more you get to keep, right? Then look at their experience and their past performance. Look at how they did during different market conditions. During COVID, how did they fare? Did they get many right, many wrong? Were they able to protect your capital? Consider how the results compare to the market index. So that's the market performance. Judge them against that, because at the end of the day, you're paying them a fee. What's their investment style? Are they a growth manager or a value manager? So those are the different styles, and you can assess them accordingly. Do they buy large companies, which are generally established, or do they buy or focus on small companies that are a bit more risky? Do they look for the next growth story, or they prefer stable blue chip companies?
Just quickly, blue chip companies means?
Blue chip companies are well established, the prime companies, well known, well regarded, have a better reputation.
Right, I've heard that term and I didn't quite know whether it had like an official definition, but that makes sense. Okay,
Yeah.
So some prefer to work with those blue chip companies and some kind of go for the ones that are on the come up?
Yeah, absolutely.
Right.
So there's a bit more risk associated with them. Now in Australia, we've got plenty of companies, but they're still pretty restrictive in the types of sectors and the industries we have here. So some fund managers invest globally. You'd want even more diversification in that instance. You'd want to judge them on how big their team was. Would you rather have a bunch of investors travel by train sitting in a Collins Street office, or have a team that's spread all across the globe to provide insights to get the best shares? The big benefit of using a fund manager is that with only $500, you get exposure to a range of companies in their fund, a lot of diversification, as well as access to the expertise of the fund manager. They do all the legwork for you.
Right. Now, off the back of me now learning what a blue chip stock means, there's another term that I've heard, ETFs, not EFTs, because that's FPOS, I know that, but ETFs, what is that? Where does this come into it?
Trainer, that's already a good start, so well done there.
Thank you. Pat myself on the back. Thank you.
I've used that acronym interchangeably and then been corrected. So we're both on the same track here. An ETF is an exchange-traded fund. It is a type of managed fund. They trade just like companies on the stock market. Their value will increase depending on the share price of their portfolio, right? As we discussed in the managed fund. A good thing about an ETF is for them to trade on the ASX, they are governed by a few rules that they need to follow. And the one that I believe is the most important, they need to ensure there is always a buyer and a seller available for you to trade their fund. This is important because for a classic managed fund that trades on the ASX, sometimes you may want to sell your shares, but the fund may not be that well known, so there's not a buyer in sight. Or if there is a buyer, they're not willing to pay a fair price. The ETF takes that risk away. Also, ETFs traditionally are passive investments. So their performance mimics an index like the ASX 200, as they had a sample of the stocks on the index. Stock selection is automated and they don't have a human doing strategic stock picking. The goal was always to mirror the performance of the index that provided a good return anyways. Nowadays, the newer ETFs are more active, where they have expert research and there's a bit of stock picking to provide a better return than the index. So ETFs have definitely grown in popularity and they serve as a great option for beginners to commence with a minimum spend of $500, removing the risk of not being diversified, right?
Okay, so we've covered the basics. What are some common mistakes that people who are new to this really should be looking to avoid?
Top of the charts is following up a tip from a friend without any research. Okay, we've all done that. Oh, this stock's going to go through the roof. Why, how, when?
Nobody knows.
Nobody cares. Just want to make some money. We all hear the stories about a friend who buys a share in a company for 5 cents and then sells it for $5. Or even a lot more in some cases. Naturally, we are inclined to want some of that action. But in my view, that is luck and akin to gambling. If you're going to buy shares directly and not via a managed fund or an ETF, try to remove luck from the equation and research companies that will give you strong, reliable, long-term results. Okay? The second risk, I guess, is along the same lines and following the crowd and not actually researching the company's actual prospects. Best example comes to mind are lithium stocks. They became highly popular due to their role in electric vehicles. Initially, any company with a hint of lithium exposure performed really well because everyone was buying it. That's what we call speculation. Now, everyone's got these lithium stocks. Nobody knows what they're doing. Some companies out there hadn't even found lithium in the fields they owned. Right?
They were just expecting that they would.
The possibility of them finding made them speculate in those stocks. And what happened? Lithium prices came down. The excitement kind of wore down, and pretty soon those investors in the speculative stocks were very, very disappointed. Okay. Now, just as you buy stocks, you can follow the crowd into being afraid and start selling good companies. Remember COVID? We couldn't fly. So everyone was afraid about Qantas, right? Oh, Qantas is just it could go bankrupt because it's not flying. That's its only job. Is it going to be shut down for 6 months or 12 months or forever? But some smart investors, had guessed that the government would probably bail them out, didn't sell, didn't panic, didn't follow the crowd, and ended up making a lot of money from there. Okay? So doing your research pretty much. Now, what's another mistake? Trading too often. Remember how we spoke about long-term investing better than short-term investing? Especially for beginners and those who don't want to have time to put in the research. There's a general consensus that as humans, we hold on to our losers, hoping to recover our losses, while we sell our winners too soon, missing out on future growth. For example, if a stock goes up 20%, we ask ourselves, can't it go up 20%, another 20%, right? To combat this urge to quickly sell at the first sign of a good profit, if a share does increase substantially, perhaps it's better for us to pocket some of the profit but keep the rest of our investment. No one ever loses money by taking profit. So it's not the biggest threat out there. But conversely, when shares are losing money, consider why that is. Based on your research, is it a temporary loss that will soon rebound? Or was it a bad investment all along? And you need to get out to limit your losses. Always keep in mind that investing in shares is for the long term. Research and try to make wise choices when you buy shares and let them grow over the long term and stay calm during the short term dips. All right. If this is not for you, you're better off going with a managed fund and an ETF where you're not actually looking at that volatility. Ooh, what other mistakes do we have? Letting emotions take over. If you're going to buy individual companies, research the company, understand them, keep track of the news, not blogs, but actual real news. Learn to understand the financial statements. If the price falls, understand why that it is. And if you persevere with the stock, go the distance. Remember your initial reason for buying it and wait out until you reach your goal. Even with Trump's tariffs, for example, keep calm and try and work out how his policies will impact the companies you're invested in. Is it a short-term impact or is it a long-term impact? Try and be logical and almost mechanical about this and stop being reactive. Take a while before you make a decision. As I said, if you're the type of person who would find this hard, take a more backseat approach and possibly rely on the expertise of a professional. At the end of the day, we're doing this to make money, so we want to give ourselves the best chance possible. And I think finally I'm going to touch on having this get rich quick mentality. It's a big trap for many investors. Making money is generally hard work, right? And it's slow. And there are often many mistakes along the way. Time is what it takes. Don't try and rush into fancy things like taking out loans in order to invest. Until you're actually experienced in the basics of share trading or investing. Me, myself, I've learned the hard way. You name it, I've tried it because I wanted to reach my goals faster.
Didn't work?
Not all of them. Some caused a lot more pain than others did. But that's what I finished university and I rushed into things. I wanted to get to places sooner, right? In the end, the biggest lesson I've gotten out of this is regular investings with a few of my favorite fund managers. The occasional stock purchase builds real wealth. It compounds over time. When markets fall, I try and squeeze the belt a bit tighter and spare a few bob to buy some more shares. Okay?
The ones that are like on sale and little bargains.
That's right. And really strong companies.
Right. Okay. Now, it feels like, Adrian, we've been on a whole journey here, start to finish. I feel like we're 3 or 4 layers deep. Whereabouts are you? I mean, you're a financial advisor with BG Private, right? So where do you sit in this whole process? What is it that you do?
Well, firstly, I hope your listeners have a better understanding about share investing than what they started off with at the start of this podcast. We've talked about things that make it really easy, and there's some parts that are really complex. As a financial advisor, I work with my clients on the following types of things. We start off with their goals and their time frames. It's important. We work out if the goal is to buy a home in 5 years or is to have enough money in retirement in 25 years. Okay. Then we look at the best tools to get there. Budgeting, saving, cash flow, superannuation, retirement planning, and of course, investing is all part of it. When it comes to investing, there are lots of options, and it's not always shares. A client looking to buy a home in the next 6 months probably shouldn't be investing in the share market, as their focus should really be on preserving their capital. Now, if it's decided that investing in shares is the right thing to do, we can recommend a portfolio of managed funds and or direct shares that we expect will meet our clients' goals. Throughout the journey, we then continue to monitor their investments to make sure they stay on course so that they reach their financial goal. I guess to summarize it all, we enable our clients to make more informed decisions that leads to better outcomes and taking a safer path.
Fantastic. Well, thanks so much for sharing that with us, Adrian. And I hope you listening to this right now feel a whole lot more prepared to dip your toes into investing. Adrian, thanks heaps.
Oh, brilliant. Thanks for having me here. I'm in this business to help clients reach their financial goals and more than happy to help navigate anyone on their journey. And in time, we'll celebrate the success together.
Okay, well, if you want to meet up with Adrian, much like I've done during the show today, to find out how he can help you, you can head to bgprivate.com.au and contact the team there. They can connect you with Adrian. He'll be happy to help you out, no doubt.
Fantastic. Thanks, Trina.
Thanks. The information in this podcast contains general advice and is provided by BG Wealth Management AFSL number 496348. That advice has been prepared without taking your personal objectives, financial situation or needs into account. Before acting on this general advice, you should consider the appropriateness of it having regard to your personal objectives, financial situation and needs. You should obtain and read the product disclosure statement before making any decision to acquire any financial product referred to in this podcast. Please refer to the Financial Services Guide available at bgprivate.com.au for contact information and information about remuneration and associations of product issuers.